people ask me quite a bit, Ben, I appreciate you sharing what other people think, but I want to know what you think. And so I've learned that that's what people want. So I'm going to give you a couple of perspectives on the market. One, a cautionary view, which I'll call intermediate term, and then a positive view, which I would call short term. So, and I'll go through those with you. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is October 8th, 2024. I'm going to give you a view which is a cautionary view from Edward Dowd, it being interviewed by Daniela Cambone. And a good interview. He's, in my opinion, very insightful. He is talking about the debt and probably at some point the unwinding of the debt, both in the US and in the world, because countries all over the world have printed money galore and debt galore. And I'm not sure the real difference between those two, the way they're being treated. But he goes through that quite a bit. And I think it's important to understand that what he's saying is it's an intermediate to a longer term view. In other words, I don't personally think of this as, excuse me, something to be concerned about today or this month or next month. I see it as a little bit longer term, but it is something to be concerned about. We have been about 15 years from a collapse, and we've had several of them. I can remember four in my adult lifetime, and they are all about a drop in the market of about 50%. And in looking back over the last 220 years, there have been about 22 collapses, which works out to be about one every 10 years. And you could even stretch it out and say once every 15 years, but we are at this point beyond the average. At some point, the market and probably the economy with it, although they can be different, is going to collapse. I mean, a real collapse like we've had before. And I don't know when. I mean, it could be a year from now, a couple of years from now. I don't know. I mean, I think it's in our future. It's not imminent, but it is coming. My message is just be prepared so that whenever it comes, you have a strategy on how to deal with it. You can learn from the past. You can learn from my comments about you be careful. And each style is different. I'm tactical in the way I do things. Some people are strategic. So whatever your method is, be prepared. And so as he talks about the idea of at some point the debt is going to have to come unwound. And I can quote a lot of people I follow about debt, and sooner or later, countries can only stand, just like individuals can only stand so much debt before it collapses around them. So take a listen to Daniela Cambone and Edward Dowd.
You've been saying, since I've known you, Edward, that this is the global sovereign debt bubble, the everything bubble. And you point to what just happened in Japan, which took a lot of us by surprise. And now you say that the clock has been set for the global unwinding of the debt, and it's going to be in conjunction with a weakening U.S. economy. I'm predicting it's just the clock getting started. So let's get your thesis here as you see this global unwinding of debt happening.
Yeah, so the global debt bubble has been building for 14 years. You got to go back a little bit. So the Fed system, lowers interest rates, creates a bubble. The bubble, they don't actually control where the money goes, and there's a bubble that's created, and the bubble usually ends when they raise interest rates, take away the punch bowl, then some fraud somewhere is exposed. In the 90s, it was the dot-com frauds, corporate fraud with Enron and WorldCom, and other companies that just disappeared overnight, went bankrupt. Then they had to blow another bubble to save the economy again, and that was a real estate bubble that ended up on the bank's balance sheets, and that was just that was just fraud everywhere. And not one banker went to jail, I remind you. Then, to solve that debt problem, they needed to create more debt. The system needs constant debt creation because money printing is actually debt creation. So they printed more money, created more deficits, and for 14 years, we had basically zero interest rates. And it was going to pop at some point, but because it had gone to the fraud had rolled onto the central bank balance sheets, because remember, they bought all the fraudulent bonds to save the system, and the government spent like drunken sailors. The fraud rolled into politicians and central bankers. So here we are, and it was going to manifest eventually in the foreign currency markets, because eventually the release valve is FX, and that began in Japan. Japan kept their interest rates at zero as the Fed was raising interest rates to 5.5%. By the way, that's the fastest rate of change increase we've ever seen in the history of the Fed. It went from 0 to 5.5. So the money supply started coming down, and Japan got into a bit of a currency crisis. And not that long ago, Japan, the US dollar JPY pairing trade went to 160, which was the levels we hadn't seen since the 90s. So Japan was in the midst of a currency crisis. Their debt to GDP is 290%, I think, versus our 120%. So they had to defend their currency, and they raised interest rates 25 basis points in August. We saw what happened. The Nikkei crashed, and the U.S. stocks followed. That was the beginning. That's the clock starting. It's gonna, it doesn't happen overnight. There was a lot of coordination between the Fed and the Bank of Japan. Right. And they're basically trying to hold it together. And since the markets swooning in August, the JPY US dollar pair trade has gone from 160 to 139 last night. So the Japanese yen is strengthening as the yen carry trade is unwinding. And the yen carry trade is a trade that's been going on for decades. People borrow in yen because the interest rates are zero, and they lever that up and buy foreign assets. So the problem is that Japan is caught between a rock and a hard place. Save their currency or unwind the yen carry trade globally. And I suspect they're getting pressure from the U.S. government and the Fed, and they're caught between a rock and a hard place. So that's the clock starting. And we also, in conjunction, have a weakening U.S. economy that we were predicting a recession in the second half of 23.
Right.
That didn't happen primarily because of unprecedented government spending, government job creation, illegal immigration added to the GDP. But that juice peaked in March, according to our early cycle indicators, and we never went above. We have a metric. It's above zero is expansion. We got right below zero, and then we rolled over. So our economic cycle indicators have been rolling over since March, and we believe it's going to pick up speed. We have an election where every business right now is paused. I'm hearing from everybody that no one's spending any money. Large projects are not going to happen until after the election.
Okay, now I'm going to shift to a short-term view. And when I say short-term, I mean probably the next 3 months, maybe 6, but maybe just to the end of the year. So definitely a short-term view. So I'm going to play for you 2 pieces, one from Tom Lee from Fundstrat, and then the other from Sylvia Jablonski. Both well thought out, giving good reasons for their thinking, and they're seeing that the market, and let's say maybe the economy as well, is going to continue to climb. I won't say accelerate because that might be giving it too much credit, but probably continue to climb to the end of the year. They don't really go beyond that. But what we think of a lot of times is geopolitics. Okay, we have an election coming and it means this or that. But people have been thinking that for the last several months, maybe even part of this year, and that, the market is going to collapse or it's going to pull back. Really, it hasn't happened. And what I see typically is that geopolitics does not play into the market as much as people think it's going to. So anyway, a good perspective. So I'll begin with Tom Lee.
When it comes to finding overall value right now, our next guest points to October as a seasonally iffy part of the year, expecting investors to buy whatever dip emerges this month because the positive tailwinds into year-end, he says, are stronger than the headwinds. Joining us today is Tom Lee, Fundstrat Global Advisors Managing Partner, a CNBC contributor. Hey, Tom, good to see you.
Hey, Carl, how are you?
I'm good. What do we make of the market in light of the jobs number and a VIX, which I know you're watching, but is still close to 20 today?
Yes, I mean, I think we're in a tricky period because there are these sort of complications, which is geopolitical risk. We've got the port strike out of the way, and I know October has these seasonals. I think it's very good news to see the stock market react positively to a jobs report because it is, in fact, a good report showing the economy is actually not only holding up, but the unemployment rate's down. But I agree with you. The VIX is important to tell us how much we could rally. I know our head of technical strategy, Mark Newton, thinks that we're making intraday lows today, and it's setting up for us to make new highs next week. I mean, to me, that makes sense just because it has been a resilient economy, and then next week we get CPI. But I do think it's hard to say this is a green light into year end because, as you're pointing out, the VIX is just staying stubbornly high.
And then finally, I want to play Joe Kernan interviewing Sylvia Jablonski. Again, similar thinking to Tom Lee, that she sees a positive view of the market, at least in the next few months. But again, see, we can get lulled to sleep by this. And so I'm just saying, think about beyond that. Think about, okay, what about next year or the year after? At some point, probably when you don't expect it, the market's going to reverse. And I'm not trying to be negative on top of good news. I'm just saying, take it for short term. You can believe it or not believe it. But then as you look out, kind of have, the way I think of it is one foot on the brake and one foot on the accelerator. Just be prepared for whatever comes. So here's Joe Kernan and Sylvia Jablonski.
Busy week ahead for the markets with inflation data and bank earnings on the agenda. Joining us now is Sylvia Jablonski, Defiance ETFs co-founder and CEO. Even though we've seen some, I don't know whether you call it anxiety or maybe skepticism about the 50 basis point cut in relation to what that jobs number we saw on Friday. You're taking it at face value, I think, Sylvia. Soft landing, rates coming down, earnings staying strong, inflation under control. It's all a green light for you for stocks?
It's all a green light for now. I think the U.S. job numbers beat expectations on all fronts. Wages looked good. That tells us that the consumer will likely continue to spend, which feeds the economy. The S&P 500 is up about 20% in 2024, which added $8 trillion to market cap. I mean, it's hard to argue that it's a bad year and that a recession is looming. So I think earnings are strong. The Fed has been, favorable to markets, supportive of markets, at least, with the last rate cut, and is projected to be the same depending on data going forward. And I think earnings are looking pretty good. We're expecting 4.7% growth year over year. People are working, jobs are strong, and earnings are good. I think that bodes well for a soft landing and a bull market into the year end. Barring any kind of major issue, which we do have some caveats there with what's going on in the Middle East. We don't know what happens there. But barring, that kind of escalating further beyond what we expect, the market could end up rallying into the year, I think.
Okay, thanks for watching. If you have questions or comments, leave them in the comments section below.